Welcome back, everyone. We're here with Fraser Lang of GBL Inc., a company that he started by his father 35 years ago, I think, right?
25. So it's our
25 years ago.
anniversary.
And today we're going to be talking about the ultimate IPP. It's otherwise known as the individual pension plan. But before we jump in all of that, let me just tell you a little bit about myself and Patel Wealth Management. So Patel Wealth was actually created in 1981 by my father. And back then it was more of a stock brokerage business. From that day to where we are today, we've totally morphed it into more of a wealth management business where we're actually giving recommendations and helping people make better decisions financially. A little bit about myself, Associate Investment Advisor. I'm Sheean Patel, and my job is more the facilitation of all the different moving parts in wealth management, and Chick takes care of most of the investment management. So I want to just kind of introduce Fraser here. Fraser, do you want to just tell everyone a little bit about yourself?
Sure. My name is Fraser Lang. I'm the head of sales and business development for GBL. As Sheehan mentioned, we were established in 95. This is our 25th anniversary. We have over 7,000 clients we've served amongst the different strategies we employ. GBL is a little different in the sense that I am not an actuary myself, which is a good thing. I can translate the technical side into plain English. But my background is primarily dealing with taxation and financial planning. So really, we have a unique strategy of going about discussing this. We're looking more as to whether an IPP or an RCA or some of our strategies could fit in based on the financial planning needs that exist. So does the company have a need for deductions? Does the individual have only a small amount of retirement assets retained? So the idea here is not to try to put a strategy in place where it's not a good fit. And I think attacking it more from the perspective of planning, it becomes clear whether it makes sense or not.
We totally agree. Financial planning is kind of the forefront of our business now, and really everything kind of funnels in through those plans that we built. We've been working with Fraser for many years now, specifically in the individual pension plan space, when starting a little bit more with the retirement compensation agreements. And for all the viewers on there, we are going to talk about those things in a week or so. So please tune in then. So let's start talking about like the IPP. So what is the IPP, or the individual pension plan, Fraser?
In the most basic terms, it is a self-directed defined benefit pension plan. So a defined benefit pension plan is like what the teachers would have, or different members of public service. We don't tend to see a lot of it in the private sector these days. The reason for that is it normally has a funding liability, meaning the company is on the hook to fund certain things. The difference here with an IPP is we're setting this up for the business owner, spouse if they're receiving T4 from the company. In the case of a family business, if the next generation's taking over, we may add them onto the plan as well. The rules that are there for IPPs for what we call connected members, or people that own 10% or more shares in the company, are a little different. They're flexible. If you cannot fund a contribution in a given year due to cash flow issues, there's no penalty or issue. You can always fund that down the line. If you sell the business, you can wind up your plan to a locked-in RSP. So really what we're doing here is it's the ability to put more money into the plan than you could into an RSP. We're really looking at individuals age 40 and older, because 38 is the crossover point between IPP and RSP. So if you're younger than 38, you get a larger contribution to an RSP than that of an IPP. We can also go back and capture something called past service. So past service is saying, had I been in an IPP since I incorporated, here's the additional money that can go into the plan. It's deductible to the company. In some cases, we could be looking at a six-figure number. So the idea here is we're taking pre-tax corporate dollars to fund your retirement. It's deductible to the company as an expense against active business income. And any expenses associated with the plan are deductible as well. So investment fees are deductible to the corporation as an expense, whereas that would not be deductible in an RSP. And of course, our fees are deductible as well.
Interesting you say that. Yeah, IPP is basically RSP on steroids, if you will. And the one thing you did mention there, which I really liked, was it's deducted from the corporation. When you have an RSP, it's actually it's your tax dollars, right, that you're paying out of your own pocket to fund the thing. So let's jump in. Who are these IPPs best suited for? Is it like any given person that doesn't have a business, or do you have to have a corporation, or how does this work?
Well, there's really, I mean, I would say there's three main criteria you're looking at there. First off, you do have to be receiving T4 income from an incorporated entity. So it would work well with a small business. It works well with incorporated professionals. Keeping in mind, we can only use box 14 off your T4 slips. We cannot use dividends. Dividends do not create employment income. The second point is age. For the main member, I would usually suggest age 40 and older. I would say 45 to 70 is the optimal age, and that's really where we get a reasonable spread between what you could put into an IPP rather than that of an RSP, because you want to have enough spread, obviously, to offset, fees and expenses. So, and then finally, your T4, the amount of your T4 is a factor. This year, 155,000 of T4 maxes out your IPP. It's up to about 162,000 and change next year. So the closer your T4 is to that number, the higher your contribution room would be. But once again, that's not always one size fits all. I had a couple clients a few years ago. They were 68 years of age. They owned a small corner store. They're paying about $30,000 each in T4, but for the last 20 years. And because of that age and those 20 years of service, we were able to create a $300,000 deduction to the company. So it's not necessarily you have to be at that income, but I would say, if you're 45 and paying yourself 40 grand a year, it's probably going to be a nominal contribution you could put in.
So it's good to know you got to pay yourself an income on that's box 14, like you said, right?
Exactly.
Yeah. So 40 years old, about 150 grand in income. So why don't we just talk about a little bit how this like IPP works generally in the most basic term possible. You did touch on it about the company giving the contributions and write-offs. So let's just touch on that for our viewers. And viewers, if you have any questions, put them in the Q&A box down there. I will answer them live on the air with Fraser here.
Sounds good. What we normally do is we have a questionnaire the client would complete, giving us their historical T4, how old they are, and how much RSPs and unused RSP room they have. That would factor into it. From there, we would run a quote or illustration that shows a comparison between an IPP and an RSP to show whether this is beneficial or not. Once the client goes ahead, where our role is purely facilitating the establishment of the plan and the ongoing filing. So we do all the legal documents that go into it. All of the banks and major financial institutions don't normally have an actuarial department, who is an actuary, a professional, a little different from an accountant, but thinking of it under those terms. Those are the people that do the calculations and sign off on the plans. So as a result, because it's fairly niche, you normally have an outside party that provides that work. So we would provide a trust agreement that allows the client to open up the account and invest it on your side as an open account for a trust, if we want to be technical. But basically, it is a registered pension plan. GBL is doing the tax filings to the government. The government is aware this plan exists. So although it is a trust account, for all intents and purposes, it is a registered plan. And then the client would sit down with you and determine what investments they would like to have the IPP hold. We don't advocate any specific investments, nor do we get compensated on that. We would bill the client directly for the work we do.
Fantastic. Yeah, actually, this is a good point on the investment side of things. I've heard from people that I've talked to in the past, some of them, that they have to write big checks, I guess, and then sometimes their investments aren't matching the growth of the plan or the plan projections. You touched on that just a little bit.
Sure. So what happens, because it's a defined benefit plan, just by the definition of that of those terms, your pension in retirement is a result of a 2% formula. So we look at your earnings each year. We take a 2% of that up to that RSP maximum, and we add up all those years together. And then on a rudimentary basis, that's your starting pension. So in order to be able to have, define your pension, we need to have an interest rate assumption or growth assumption on the plan. The government set these rules up in 1991, so keeping in mind that there is a 7.5% growth assumption that is there, but they're also using a 5.5% inflation assumption. So, not to go too far down the rabbit hole, but inflation is a lot lower than 5.5%. Therefore, you're probably seeing more about 5.5% is really the return right now when we look at the spreads. So what happens is after 3 years, we create a report. If your investments have not returned enough to fully fund the benefit, your plan is in what we call a deficit. And you have, and I must stress this, you have the option of putting more money in to bring the plan up to that level. You're not required to under the rules. You can carry a deficit within the plan if you don't want to fund it. But we do have some clients that are bonusing amounts they don't need to stay below the small business tax level, and they often want to use that additional room as a means to, instead of taking that bonus, it is deferred into the IPP.
You made an interesting point. The rules about the growth is at 7.5%, and inflation at the time, I guess, in 1991 was 5.5%. Is there anything in the works that they're going to change any of this stuff?
We haven't really seen a change, and the interesting thing is from year to year, we've seen the RSP maximums not go up at that 5.5%, but this year it's actually a significant jump from 155 to 162, and it's pretty close to that 5.5%, so it's quite interesting. I think the reason we don't see a change is those were historical numbers they were looking at. It's interesting when you've been at this as long as I have. This is my 18th year at GBL. You've seen market cycles, and you've had meetings with clients where they're reviewing their valuation report. And, in 2008, 2009, I had clients saying we'll never see a 7.5% return again. And then after 3 years, when the next report came out, a lot of them were in surplus positions because the markets did return a higher amount. So we haven't seen any movement or discussion of movement on changing those assumptions at this point.
Okay, cool. Okay, so let's just talk. You did say something about people in the family joining the plan. So it's called an individual pension plan. And then you touched on connected people, 10% interest in the company. So I guess these things can have more than one person?
Yeah, I mean, often we'll see cases where the spouse might be on the books and be doing like some work in the office. Maybe, I mean, there are many cases, obviously, at the small business where both both the member and the spouse are doing equal work and taking a lot, but in a lot of cases you might see a spouse, pulling 40 grand T4 a year to do office work and things like that. We can add them joint onto the plan with the spouse. And where the advantage is if one member dies, the assets stay within the plan and flow to the surviving member. There's more money in there than they have pension credits to absorb usually. And basically the company gets a contribution holiday. And where it becomes even more interesting is where we have a bona fide family business. And we've seen this a lot of cases. Mom and dad are in their late 60s, let's say they're 69. They've had the family business for 20 years. Kids are in their mid 30s and now are taking a prominent role in the business. And we know they're going to continue it after mom and dad retire. We have mom and dad on the plan. We add the kids that are T4'd from the company onto the plan. That is a very important consideration. And it also is important that the kids are going to continue to operate the company after mom and dad pass away. If that is the case, we add the kids onto the plan. Mom and dad pass away, and any residual assets that would be earmarked for mom and dad now have flown down to the kids within the plan. We have no tax triggered at that point. And when you think about it, when you're looking at an RSP or even an IPP where it's not a family business, that upon death of the second spouse, the assets are taxed and either divided amongst the children or the estate. So it can be a great planning tool for family businesses to have that intergenerational flow down of wealth.
Hey, it's interesting you actually talked about the flow of wealth here. So I wanted to just touch on one thing. What if, like, say the parents who started the business are now 69 years old, have never done an individual pension plan, and then the kids in the center are all working in the business now, and they're thinking about it. Is this something that can be done? Is it beneficial?
Well, it would be, I mean, it's interesting for like we could set it up with the parents, and the interesting thing there is we can go back and capture that past service that I mentioned. So what we tend to find happens is the parent service represents a very large deduction to the company that they can contribute to. They do need to start taking a pension at the end of the year they turn 71. So if it's a case where it can be a great case where we can say, you know what, mom and dad have done a great job in building this business. Let's pay forward the pension for them for all their years of hard work. We're going to fund this for them. And then we've got the added bonus that if, you know, we're added to the plan and something happens to them, you know, that it's not all going to be subject to tax in one fail swoop.
Yeah, so I mean, if you had an RSP that was like $1 million and your parents both had them, say, and they died instantly tomorrow for whatever reason, you wouldn't be getting taxed 52% on $2 million, right, as income. The money would just flow and keep in the plan and flow towards the children's portion. Is that what you meant?
Yeah. So basically, it's almost one generation's paying it up forward to the parents, who are then paying it forward to the kids. I mean, hopefully mom and dad live long enough that there's no money left in the plan for them, but in the event that that doesn't happen, it can be a great opportunity there.
Cool. So I guess let's talk about some of the benefits versus cons of having an individual pension plan.
Sure.
So what are some of the benefits for the person who's the main person of the plan, and like some of the cons, I guess?
Well, I mean, first off, for their company, because I mean, if they are the owner of the company, their personal dollars and corporate dollars, although they're separate, I mean, technically it's part of their net worth. The ability to tax efficiently fund a retirement benefit for them much larger than an RSP would provide, while taking less risk than you would have to take to have a similar benefit from an RSP, because an RSP is based on, you know, you throw your 26 or 27,000 in if you got the max contribution, you hope that the investments return a certain amount, and from there you draw an income. In this case, because we have the ability to have the company top it up if we want to, you're able to take less risk. So that's beneficial for them. Creating all these deductions and making the investment fees deductible to their plan is huge. Like if you took a person with an IPP that had $500,000 in assets, and let's just, to make the math nice, a 2% investment fee, that's a $10,000 deduction of fees to the corporation. Whereas if they kept it in their RSP and let's say there was $500,000 there, that $10,000 fee is not deductible to them. So really that offsets a lot of our fees. You know, we charge on a one-person plan $1,600 per year, which is also deductible. But I mean, if you're at a $400,000 or $500,000 market value of your assets, that pretty much offsets the fees that we would pay or that we would charge. It is also creditor proofed, which is huge, I think, for a lot of business owners. I think especially when we look at what's happened through this whole pandemic, companies that had really strong cash flows are very viable businesses where they're not able to have their clients come in. We saw dentists. Dentists are usually recession proof, except for when they're not allowed to see their clients, right?
Yeah, totally.
So, I mean, I think it gives that ability that if something was to happen, I think we're also used to things going up and up and up, that I think this disruption gives us a second thought of what happens if something does disrupt the industry and my company. What if it's not viable anymore? We now have assets that are there earmarked for them for retirement that creditors can't come after. And I think that's a huge tool.
Yeah. Oh, you touched on a lot of the benefits here. Are there some cons to having an IPP?
Well, I would say, you know, what I tend to hear as you know, first off, I think one of the misnomers was the flexibility of it. People were under the impression that no matter what happens, you have to make a contribution to a plan. And I mean, in a few provinces, that still is the case. In Ontario, they're not currently enforcing funding. And on top of that, we have a bill that's sitting in Queen's Park called Bill 213, which part of that legislation, it covers a bunch of different areas, but one of them is IPPs, where if it goes through, IPPs will be exempt from provincial legislation, which means they're even more flexible at that point. So part of the drawback is people feel that they're inflexible and that they're, administratively cumbersome. When we get the province out of it, a lot of the filings we do are provincial ones, and if we're only filing this to CRA, a lot of the complexity is going to come off of that. And the other side is cost. And as I mentioned, with the additional deductibility of the fees, that tends to saw off the cost side.
Yeah, cool. So why don't we talk? You did talk about contributions. Let's just really simply, how are these contributions actually calculated? Because you did say that you could put more into an IPP versus an RSP, correct?
Yeah. So to give you an idea here, so for those that aren't aware, RSP room is created by a static number of 18% of your earnings up to the 155,000 we're talking about. It's 154 and change, but call it 155 just to make it nice and even. Regardless of whether you're 20 years of age or you're 60 years of age, it's 18%, and that's a static number. With a defined benefit plan, at age 38, it's 18% of earnings, like an RSP. Younger than 38, it's lower than 18%. As you get closer to age 65, that percentage of earnings we're using to calculate the room grows and grows, and it's about a 60% higher contribution amount at age 65 than it is for an RSP. So the gap between the two grows as you get older, and that's where you cover off a lot of that.
Yeah, so if you have a lot of money in your corporation, that could be a good way to take it out of your corporation too, I guess.
Yeah, exactly. I mean, if we have somebody with 10 or 20 years of service, or we may be looking at, depending on what they T forward, it could be a couple 100,000 of past service that they can contribute. And the nice thing about it is they don't have to do it all at once. If they need to, they can, or they can spread that out between now and retirement. And the other side that we find interesting is due to the fact that in 2018, the government made some fairly dramatic changes to the taxation of corporations, where if you retain too much money within your corporation, for every dollar of earned income over 50,000 amongst your associated companies in a year, you lose $5 of this, what we call the small business deduction limit. So it's $500,000 for everyone. If your active income's below that, you pay a much lower corporate rate than income above it. So for some people, they saved within their corporation, and now they have an issue that if they have 150,000 of earned income in that given year, they have no small business deduction limit. What the IPP allows them to do is they can take some of those passive assets and get them out of the corporation, put them into the IPP that grows tax deferred. And in that case, that might help them stay below that line so that they don't lose some of that very important small business deduction limit.
Yeah, totally awesome. Okay, so why don't we just jump a bit further ahead here. Now we're retired, so we have two types of plans. I guess there would be multiple people or one person. So why don't we talk about if there's one person and you're retired, what happens?
Sure.
How does the IPP work?
So what happens is you basically have three options at retirement. If you're going to continue to have a corporation in retirement, what we often see people do is they may take the pension directly from the IPP. So the IPP stays intact. They have the ability to often put a six-figure contribution in for what we call terminal funding, which allows for a larger growth rate from year to year on payout on their IPP. And then it just pays out. If they pass away, the spouse would get a survivor pension that pays out till there's no money left in the plan. Often what we'll also see clients look at is option B, which is that you terminate your IPP and you transfer the assets to what we call a locked-in retirement account or locked-in RSP. Similar to an RSP, you just can't gut it when you want to.
Yeah.
And in Ontario, after 55, half of that gets unlocked when you start drawing it down. So you could technically at that point take out half the money if you didn't care about taxes at that point. Where we see that a lot is where people are selling their business and maybe don't have another company they can port the IPP over to, or they might just say, hey, I don't want to have one of these plans anymore. And then the final option is they could take the assets, take the pension calculations we have, go to an outside life insurance company and purchase an annuity. I won't go into too great detail there because we don't tend to see that very often. With interest rates being low, annuities are very expensive. And upon death of the member and the spouse, it doesn't flow to the kids. So at least in the locked-in RSP or as a pension, the kids will inherit money if there's money left over, whereas it doesn't in the annuity case.
Yeah, so then let's just talk about now, like say it's a family-run business and you've got 2 or 3 generations in there, and how does it work when the first generation retires?
Well, first generation retires. The only difference really that happens there is we do calculations for their pension amounts, and they start taking a distribution or withdrawal from the plan, just like you would have if you were, a teacher or someone else. You get your check from your IPP. It's taxable income to you. You can split that income with your spouse if you want. The kids are still active in the plan. The kids are still able to contribute to the plan on an annual basis based on their T4 and age. So really, it doesn't change that much, other than the fact that we do have payouts, and you may want to have some of the assets invested in something that's going to create some income to cover off those payouts. But beyond that, it should be pretty much same as.
Yeah, there was a question here. Schick asked it, and it says, can you take the unlocked plan and transfer it to an RSP after age 55?
Well, yes, but it's actually a RIF, and I know we're throwing a lot of acronyms and things around. And
yes,
and what a registered retirement income fund is just basically what an RSP becomes when you start taking payments from it. So you have a one-time option in Ontario if you're in a locked-in RSP after age 55, where you can take what's there. Half of it goes to that registered retirement income fund, and the other half goes to a locked-in version of that called a life income fund. So basically, half the money is in the equivalent of what an RSP would be in retirement. It's just not called an RSP, and you have to take income from it at that point.
Perfect. All right, and then I have one last question here, and it's about passing on money from you to your kids. Let's just talk about the benefits of having one of these plans and using it as an estate strategy to pass money to your children. Is it possible?
Well, once again, in that family plan, as we mentioned, it would be possible from that side. There isn't the ability, unfortunately, with IPPs to generationally transfer it unless they are employed by the company. The spouse can have, so if we had, let's say, a single person IPP and the member dies during the funding years, spouse can take the assets there and roll it into their unlocked RSP as a spousal rollover. Unfortunately, there isn't a mechanism to do that for the kids. So it would either pay to the estate if they have minor children. We have a beneficiary designation. They would name usually their estate, and when the youngest is at an age where they're comfortable with them potentially receiving a large sum of money, we can change that to the kids in equal shares. If they're looking at a scenario where they want to be able to defer, not have it all as a deemed disposition, and the kids are not involved in the business, and this would be for our next session where we talk about RCAs. Retirement compensation arrangements would allow for the kids to take the money out over time rather than a single lump sum.
Cool. Well, Fraser, that was extremely informative. I think a lot of the people on the air probably are like, wow, it was a lot of information. Thank God we didn't do the RCAs today on top of the IPPs, because that would have been just totally too much information. But I do want to let everyone know on the line, if you are a business owner or you're just interested in finding out about this IPP more, this is a 30-minute to an hour conversation between Fraser, myself, Schick, and yourself, and we can figure out the numbers for you and actually see if this is a viable situation. But apart from that, I think I don't see any other questions coming in. No. Fraser, did you have anything else that you wanted to add?
Just that if anybody does want to take a look, we can run quotes and illustrations. There is no cost involved in that, so there's no cost or commitment for us to sit down, run some numbers, and have a discussion on it. And If you are looking at that, we strongly suggest that you have your accountant or tax professional at the table so that we are all pulling in the same direction. I think, Sheean, you would agree with me that when we're dealing with financial planning, to not have the accountant at the table can just spell disaster, because there's a plan that is decided upon, and then all of a sudden you find out that they've deviated from that plan because they're having the other advice. So we want to make sure that everyone in the boat is pulling their oars in the same direction, so we're not going around in a circle.
Totally agree. Tax planning and financial planning definitely go together.
Yeah, for sure.
All right. Well, thank you everyone for joining us. We'll be live again next week around the same time. And until then, thank you very much and have a great week.
All right. Take care. Thanks a lot.
Thanks, Fraser.